Hi, everyone. Welcome to another edition of Slam and Eggs with Larson and Company. Today, we are excited to have Jeff Lee with us. He is with Lewis and Ellis. Jeff and I met at the LIC meeting, Life Insurance Council meeting, a couple of years ago, and we are really excited to have him present today. Jeff is going to read his own bio today, and we're going to jump right into his content. So, Jeff, thank you for joining us. We will have time for questions at the end. So if you have a question, jot it down for a minute. Jeff will let us know if he'll take questions during the presentation, but if not, we have plenty of time at the end for questions. So Jeff, take it away.
All right. Thanks, Margo. Yeah, feel free to jump in if you have any questions. It might make it more relevant when we're actually talking about that subject at the time. So I was just going to go ahead and tell you a little bit about myself. I'm an assistant VP with Lewis and Ellis. I've been with L&E for a little over 6.5 years. Previous companies include life insurance company, reinsurance companies, and consulting firms. My main area of practice is life insurance, working with smaller insurance companies, doing valuation work, cash flow testing, year-end work, pricing, and assisting with filing. One of the other main areas that I work in is being involved with actuarial audits and state exams, and seem to have been focusing more time on that in the recent years, and it's been taking up more of my time, which is a good thing. About L&E, we have two main offices, one in Kansas City, one in Dallas, and then we also have people working remote kind of all over the place. We've been in business for about a little over 50 years, serving the smaller insurance companies is kind of what our main target was initially, and we've kind of expanded that since then. We have around 100 employees with probably 40 plus actuaries, and covering all facets of insurance, the life, P&C, health, pensions, post-retirement benefits. And then about 3 years ago, we added a compliance area, and which has worked out really well. We're able to offer our clients more cost-effective way of filing products, and it's just made the process a lot smoother, from the actuaries to the compliance, just because we're kind of right there with each other. It's not working with another company. The services that they offer are product drafting, product filing, corporate filings, and regulatory compliance oversight. And they work with all different types of insurance companies. So, all right. Since my background's mainly on the life side, this presentation's kind of going to be geared towards life insurance audit perspective, but the same things would apply to health and P&C audit. So, we will. So, and just a disclaimer that typical things that these are not the Society of Actuaries, Academy Actuaries, or opinions of L&E. So just typical stuff. So the typical actuarial audit client would, the type of company, it's, a life audit, health audit, P&C audit. The main ones that I mainly work on are life, and some with life and health. So the size of the companies that I deal with are from small to very large. The smallest would be like 10 million in assets, and then the larger one would be up to over 3 billion in assets. So it's quite a variety, and the type of products that they offer and everything is going to vary, completely different between the companies. The frequency that kind of how often the actuarial audits that we get involved with the actuarial audits, it varies quite a bit from company to company. Some of them will go every year, and other ones feel comfortable with doing it kind of maybe every 3 years. It just varies quite a bit by company to company. So we we work with the accounting firm, and we just kind of go off what the company is feeling. If they want to do it more often, then we'll try to do it like every year. So all right, so the benefits of a external actuarial audit, provides a comprehensive report. I mean, we will write up a detailed report, which include the documents that we reviewed, any sample testing that we did, and then conclusion of our findings. The audit will also include surety of compliance, just making sure that the reserves are up to date with any new state regulations. For example, for life insurance, 2017 CSO is the new valuation table that became effective in 2020. So all the companies had to update their portfolios to be compliant. We just go through and make sure that all of the products that they're currently selling are compliant. There was a non-forfeiture interest rate change that goes into effect in 2022. So that would be, something else that we would be looking at. Audit will also offer a different perspective, kind of an unbiased view towards the company, and would present reports in such a manner. So, just kind of a different look at it. We would be completely impartial, kind of, trying to spot mistakes before they become overgrown. And there may not be any mistakes, but if there are, then it's best to catch them early, just so it doesn't kind of get out of control on you. The external auditors are on your side. I mean, we're just trying to, make sure that what you're doing is appropriate and up to the state regulations. So, and it's always good to have a second opinion. I mean, if you haven't been having an external actuarial audit, I mean, you've been relying on your appointed actuary, and it's always good to have, somebody double checking to make sure that what they're doing is appropriate. So, and, we may also find things that can be corrected before the state exam. What we've seen is the state exams seem to vary quite a bit from state to state, but the trend is that most states are going towards a risk-focused exam, and these are much more time-intensive and much more costly because of that. So one of our clients' exam like 10 years ago cost them about $50,000. And 5 years ago in 2016, when they had it done, that cost had gone up from $50,000 up to $160,000. And it was essentially just because they had shifted towards a risk-focused exam, and and they're concerned about what the cost is going to be, on the exam that they're going through right now. And I'm sure it's going to be more than what it was last time. But, actuarial audit can, kind of help that process go smoother, because you can kind of find, typically any issues that, hopefully that would come up before the exam, so the exam wouldn't have to deal with that. So,
hey, Jeff, quick question for you
Yes.
on that point. Have you seen where you've been doing, like, even if it's triannual, actuarial exams, have you seen examiners be willing to, at least to some extent, rely on the work that you've done? I don't know if that's something that I know state insurance departments and state actuaries, they're not always gonna lean towards that, but have you seen that at all?
Um, yes, they have, and it was more like before the some of these states started getting into the risk focused exam, but previously, yes. I mean, we would see that pretty often where they would you know make comments like that in their report that an external actuarial audit has gone through and checked all of these things, and so we are relying upon their report that that these things are correct.
Great, that's what you'd hope for, right? So
Right. Yeah. So I mean, it kind of made the exam for those companies go a little bit smoother, a
great.
little bit less time consuming, and so okay. All right. So I'll just kind of go through on the work that we do, for the audit and, what's included in the report. So we initially start off asking the client with a long list of documents that we would like to receive from them to be reviewed. Some of these include, annual statements, the actuarial certifications, which are just the documents that are required by the state for actuarial certification, experience studies, which would be for mortality and lapse studies that would be used in setting the assumptions for in the cash flow testing. And then also seriatim valuation extracts. And, we're going to use those to essentially, because these are the valuation system that are producing the company's reserves. And so we will look at these on a seriatim level, but make sure that the reserves that are being calculated by the company are the reserves that are being reported into the annual statement, just to make sure that there's consistency with what the company is doing and with what the company is reporting. So so some of the actuarial opinions that we will go through and review, the standard statutory actuarial opinion, and it's essentially just making sure that the reserves are computed in accordance with actuarial standard of practice, that the reserves are at least as great as what is required in the contract, and that the reserves also meet the requirements of the state. So the non-guaranteed elements opinion is required for any type of interest-sensitive products. And then the RAIS, which is the regulatory asset adequacy issue summary. And it's just a certification that the reserves are adequate. And it's kind of an extension of the cash flow testing. The C3 RBC opinion is dealing with the interest rate risk. And so it's required for anybody that's selling annuities or single premium products. And another opinion that might be required is the X factor mortality opinion. And it's just applies to any products that generate deficiency reserves, which would be like a term product. Some term products will produce deficiency reserves, and if it does, then you're going to be required to file this opinion. The trends of reserves and other key reporting items. So that we go through, like with the annual statement, and just put down like different key reporting items that we want to look at, premiums, death benefits, expenses, just kind of, and reinsurance, ceded amounts, things like this, and just kind of track those from year to year, just to make sure that there's consistency from year to year, and make sure that nothing's being reported incorrectly, or if something just happened. It's a quick way of trying to identify significant changes that, that need to be looked into further. Another big section is the asset adequacy analysis. So was cash flow testing or gross premium valuation utilized? Typically what we'll see is companies are using cash flow testing. We'll review the methods and assumptions for appropriateness. Just make sure that the methods that they used are correct. As far as determining the adequacy, what was their definition of the reserves being adequate? Does that make sense? Looking at the tests and the scenarios that they ran, were they sufficient? Were they, the appropriate tests that needed to be run to determine the adequacy of the reserves? And then the assumptions. We'll go through, analyze the experience studies for the lapses and mortality, make sure that those make sense, review all the other assumptions just to make sure that that they are appropriate, and because you want to make sure that the assumptions that are being put into the cash flow testing model make sense, so then the results are going to make sense coming out of it. And then after that, we will review the results just to make sure that the reserves being held are adequate, and then review the report just to make sure it complies with the current standards of actuarial practice. And then another part of what we'll be doing is looking at the most recent state exam, determine if there are any actuarial items that were brought up in the exam. If so, have these items been corrected? One of the ones that we came across was the company's failure to compare the in-force listings to the United States Social Security Administration's death master file. And so they weren't checking to see if their current policyholders were alive or not. And so they had a bunch of in-force policies where they should have been paying out those death benefits. And so when they did do that cleanup, their annual statement showed a big increase in death benefits that year, which was explainable, but they just needed to go through that cleanup and start that process of checking every quarter. And then another big area that we look into is the reinsurance. Just to review the reinsurance treaties, make sure that there's nothing in there that may catch the company later, as far as the type of the guaranteed language that's in the treaty, that allows the reinsurer to increase the rates, for no particular reason. Just things like that. We'll review the reinsurance reports that we received from the company to see if that's what's being reported in the annual statement. And then we'll also do a comparison of the ceded reserves in Exhibit 5 and 7 with Schedule S to make sure that they tie out. And then compare the trends of Schedule S to ensure the consistency of the reporting through the years. And other parts of the report, like the 2017 CSO, do the new policy issues comply with the most recent regulations? We just make sure that their product portfolio has been updated to be compliant with all the new regulations. Like I talked about earlier, beginning in 2022, the non-forfeiture interest rate is changing from 4.5% down to 3.75%. So essentially that non-forfeiture rate is used in the calculation of the guaranteed cash values. And so the impact is going to be that new products in 2022 are going to be required to have higher guaranteed cash values than the previous products did because of the change in the the interest rate. So another big part that we look into is the seriatim valuation extracts. So we'll validate the total from the valuation extracts to the annual statements. Just make sure that, you know, what they're calculating is what they're reporting. Sometimes these are broken down into different lines of business, and so we'll analyze it by the line of business. And within the seriatim files, they'll give us the valuation mortality that's being used, the valuation interest rate. So we can use that information to do individual calculations on our own to try to match up to what the company is calculating. And then we'll do analysis by the lines of business. I mean, typically companies will have, you know, bigger lines of business, and so we'll end up spending more time doing the analysis on that. And we just want to make sure that their work papers tie to the annual statement. And another big part that we do is the policy calculations. So from the seriatim files, we'll have the reserve method, the interest rate, the mortality. And so we'll choose, you know, a handful of policies from the main lines of business, go through, do calculations on those, try to tie to what the company is calculating on a policy level basis. Most of the time we're able to get, you know, within a tolerance level, but if we're not, then we'll reach out to the company and, you know, just make sure that, you know, try to figure out what the differences are and resolve it. And I mean, typically the companies are very cooperative, and I mean, because they want to have a comfort level that what they're doing is correct, and they're trying to help us as much as they possibly can to give us the information that we need to verify that. So in summary, it's always good to have a second opinion on the reserves that are being reported. A different perspective may raise some questions that were not there before. Possibly with the may make the state exam go smoother. And if mistakes are found, it's much better to find them out early rather than years down the road when it becomes a much more significant problem. And the frequency of the actuarial audit, you know, just ranges, you know, depending on what the company feels comfortable with. You know, either, you know, some of them are every year, and then others are, you know, maybe every 3 years or so. So I think that is the end of the presentation. So if anybody has any questions, feel free to ask them. But thank you very much for your time.
Thank you, Jeff. I am looking at the chat. I haven't seen any questions come in through the chat yet, but if anyone has a question now, feel free to go ahead and ask Jeff.
Hey, Jeff, do you have like a recommended frequency? And maybe that just totally depends on the client and, you know, the state of their actuarial department, I guess. But do you have a recommended frequency that you?
I mean, I would say it just depends a lot on the company. I mean, a lot of when we start working with a new client, initially they'll start off with every year and do that for, you know, do it like for at least 2 years until they get a comfort level. And then they may decide to, you know, go to every other year or every third year. But then, you know, a lot of it also depends on the complexity of the company, you know, the type of products that they offer, you know, if they're getting into, you know, different types of reinsurance, you know, financial reinsurance arrangements. I mean, just there can be a lot of different things that go into it that can make the audit a little bit, you know, more intense, I guess. But I mean, typically maybe start off at least the first 2 years back to back, and then kind of review it at that point, and kind of see what how you feel about it, if it's worthwhile, if it's produced a lot of questions that they hadn't thought of before, things like that. So
Great, that makes sense. Thank you.
Excellent. Any other questions for Jeff? Okay, great. Well, thank you for joining us today. Jeff is probably available for questions via email after this presentation, I would guess. Feel
certainly
free to contact him. Yep. And we will have, if we could get a copy of the slides, and we will add it to our website as a resource for those who are maybe watching a little bit later on. So thank you for taking the time to present to us. It was really informative and a lot to digest. So we appreciate you putting it together. And we'll see everybody next time. Thanks.
All right. Thanks a lot.
Thanks.